With interest rates expected to come down, is this a good time to invest into the Singapore dollar credit market? Today, I'll talk about 3 things about the Singapore credit market. First, the composition of the Sing dollar credit market. Second, I will talk about the returns thus far of the Sing dollar credit market. And third, our views and how do we position in this market environment going forward. Now, for the composition of the Sing dollar credit market. This credit market is worth over 100 billion in outstanding amounts. I like to describe this market as 30-30-20-20. It is 30% made out of stat boards, 30% made out of domestic link companies, 20% financials, and 20% non-financials. For the stat boards, the issuers are mainly HDB and LTA. For domestic link companies, you can think of companies such as CapitaLand and its related REITs, Mapletree, Keppel, SIA, Sembcorp. For financials companies, this will include UOB, HSBC, BNP Paribas, and our own bank, OCBC, just to name a few. And within the non-financials corporates that is not linked to Temasek, this will include Frasers Property, City Developments, Shangri-La. For returns in the Sing dollar credit market, the returns in 2023 and year-to-date 2024 is not too bad. In 2023, the Sing dollar credit universe, the whole market, posted a positive 8.8% total returns. This is one of the strongest returns that we saw. For this year, year-to-date 2024, the total returns are about 1%. Almost every part of the Sing dollar credit market delivered positive returns. This would include long and short-dated bonds, bonds that are higher quality, as well as bonds that are a bit more high yield. Within all these segments, the one that really outperformed the most would be corporate perpetuals. For Sing dollar credit market, in terms of defaults, there's very few. The one that had more of a total loss was Credit Suisse when it wrote down the AT1. But aside from that, if you think about the sectors in the Sing dollar credit market, such as the banking sector, the real estate sector in Singapore, and also Temasek link companies, these have been posting stable and to resilient earnings so far. Now, going forward, how do we position in this market? What still makes the most sense? Number one, we're going to state that we have no underweight position in the Sing dollar credit market. The main rationale is because we want to buy while rates are still high. Okay, this is because interest rates are expected to come down. Even if interest rates may not come down as much, we think that interest rates are likely to rise. In fact, the biggest risk will be reinvestment risk, especially if fewer companies are willing to issue bonds when rates are high. Next, another segment that we think is interesting will be corporate perpetuals. We have an overweight position there because we think that there's a high chance for their first call to be called between 2024 and 2025. We just have a recent publication where we state that quite a number of these perps are beginning to look interesting. As these perps get called, I think the interest in this market also pick up, and more corporate perpetuals will be called. Another segment which we think is interesting will be the crossover credits. These are companies that may not be the most pristine, but their fundamentals are actually still okay. So at OCBC Credit Research, we do bottom-up analysis, and we will look for companies that have still stable earnings, and we pick the companies and bonds which we think will outperform. Of course, whatever that we mentioned today may be still subject to change. This is because we are adapting to the changing conditions in the market. Follow us at OCBC Credit Research for our latest updates as we continue to publish and share our views.